The pattern continues. It's quiet here in the States. News media doesn't get what's going on, and the noise overseas is quite remarkable. Domestically, the one big news item is the Treasury borrowed $70 billion, it's 7-0, in new cash this week, which it does by selling Treasury bonds at auction. And this is the first week that the Treasury has raised money that way in 6 years without the Fed in buying via QE, and the auction went just fine. You'd never know the Fed was gone. The action is overseas, and there's a tremendous amount of money trying to get into United States securities. And that may be why the offset to QE is as easy as it is in the bond market. It's certainly a part of it. The overseas situation is spreading laterally from nation to nation. And we're now seeing in currency markets that essentially the currency of every nation on earth, except the United States, is trying to weaken versus the dollar at the same time. And we haven't seen that since 1997. And there were different reasons. There's always something different each time. But we've known that the euro was trying to devalue versus the dollar. But now the Swedish kroner, the Danish kroner, Dutch guilder, the Czech, I can't remember, I think it's a kroner also, all of them going down. The Russian ruble going down for reasons not quite so economic as the other ones. The South Korean won going down, trying to keep an even footing with Japan. Really the only non-participants are safe haven currencies like the Swiss franc, the Singapore dollar, and China for the moment has maintained a dollar peg. Probably more for pride than for good sense. Now, the linkage in all of this is the United States Federal Reserve proposes to raise its interest rate next year. The central banks everywhere else in the world propose to continue to cut their interest rates and to engage in QE if they get to zero and can't go lower. And the divergence means the money wants to run towards the higher return, which presumably is here. Even the Bank of England has thrown in the towel. The United Kingdom has had the best economy in the world on a par with the United States, but their inflation rate is falling and their economy seems to be topping out. And the Bank of England has now been postponing, pushing back the first date for a rate hike. And so the pound sterling is also nosed over and going down versus our currency. I suppose the Fed is concerned. I suppose it's thinking about it, but it's not thinking enough about it. In normal circumstances, when I devalue my currency, I print money, which trying desperately to get out of deflation and into modest inflation. But in so doing, I weaken my currency. As my currency goes down in value, my exports are cheaper to the rest of the world, and my imports are more expensive, which actually should help me get inflation going internally. It's not working. It's especially not working in Japan. A very strange phenomenon, never before seen. As the yen has gone down in value and imports have become more expensive, goods and services in Japan have raised in cost, but Japanese incomes are not rising. It's acting like a self-induced oil price shock, where all of a sudden oil prices rise, and there's no mechanism internally, and everything just suddenly gets more expensive, but incomes don't rise. And that's where we are at the moment. I've never seen, I don't think there's ever been a moment of such unanimity of weakness in foreign currencies versus the dollar underway. 1997, 1998, it was the best thing that ever happened to us. It was extraordinary stimulus to have all that money pour into the States. This time, it's really hard to tell. And it's odd, Friday after Friday, to spend more time looking overseas than domestically, but that's where the action is. Good weekend.